Take a deep breath. Close your eyes for just a moment. Now, imagine yourself sitting in front of your trading screen. The charts are moving, your heart is beating, your hand hovers over the mouse, and in that moment, that critical moment when you need to click, you freeze. Sound familiar? Right now, 95% of traders are losing money, not because they lack intelligence or analytical skills, but because they're fighting a war inside their own minds. Let me tell you about two traders who started their journey on the exact same day. Both had $10,000. Both learned the same system. Trader A spent years studying every indicator imaginable. He could predict support and resistance with 80% accuracy. After 5 years, his account had dwindled to $3,000. Trader B took a different path. He spent 6 months learning one simple system, then 2 years working exclusively on his mind. After 5 years, his account had grown to $250,000. What made the difference? Mark Douglas spent 18 years working with traders to find the answer. His discovery will shock you. The difference between consistent winners and everyone else has almost nothing to do with market knowledge. It has everything to do with how they think. The best traders think in a number of unique ways. They have acquired a mental structure that allows them to trade without fear, and at the same time, keeps them from becoming reckless and committing fear-based errors. This mindset has a number of components, but the bottom line is that successful traders have virtually eliminated the effects of fear and recklessness from their trading. When you acquire this mindset, you will be able to trade without fear. You will no longer be susceptible to the multitude of fear-based errors that come from rationalizing, subconsciously distorting information, hesitating, jumping the gun, or hoping. Once the fear is gone, there just won't be a reason to make these errors, and, as a result, they will virtually disappear from your trading. Lesson 1. The paradox of being right. There was a brilliant technical analyst working for a major Chicago brokerage firm. He was one of the best Mark Douglas had ever met, capable of predicting market movements with uncanny accuracy. One day, he was sitting with his boss, a 40-year veteran trader from the Chicago Board of Trade. The analyst had calculated that soybean futures would hit support at a specific price and reverse. As they watched, the market slowly moved down to that exact level. The analyst turned confidently to his boss and declared, "This is it. This is the low of the day." The veteran trader looked at him, then at the screen. Without a word, he picked up the phone and called the trading floor. "Sell 2 million bushels at the market," he said calmly. Within 30 seconds, the soybean market crashed through the support level, dropping 10 cents a bushel. The analyst watched in horror as his perfect analysis was destroyed by a single phone call. The veteran turned to him and said, "Now, where did you say the market was going to stop? If I can do that, anyone can." This story illustrates your first fundamental awakening. You don't need to know what happens next to make money. In fact, believing you know what happens next is one of the most dangerous beliefs a trader can hold. Think about it. Right now, millions of traders worldwide are looking at the same charts. Any one of them, with sufficient capital and motivation, can move the market enough to invalidate your analysis. A central bank can intervene. An algorithm can trigger. A fund can liquidate. Your perfect analysis means nothing against the collective actions of all market participants. This isn't a flaw in trading. This is trading. The market can do anything at any moment. Once you truly accept this, you stop trying to predict and start learning to react. Your analysis becomes a tool for identifying probability, not certainty. The best traders have evolved to the point where they believe, without a shred of doubt or internal conflict, that anything can happen. They don't just suspect that anything can happen or give lip service to the idea. Their belief in uncertainty is so powerful that it actually prevents their minds from associating the now moment situation and circumstance with the outcomes of their most recent trades. By preventing this association, they are able to keep their minds free of unrealistic and rigid expectations about how the market will express itself. Instead of generating the kind of unrealistic expectations that, more often than not, result in both emotional and financial pain, they have learned to make themselves available to take advantage of whatever opportunities the market may offer in any given moment. Lesson 2. The cycle of doom. Let's talk about your journey. Remember your first winning trades? Remember that incredible feeling of ease? You looked at a chart, saw an opportunity, clicked a button, and money appeared in your account. No fear, no hesitation, no doubt. just pure, effortless execution. You were in what Douglas calls the carefree state. Professional athletes call it the zone. Time slowed down, decisions felt automatic. Everything you touched turned to gold. Trading seemed like the easiest way to make money in the world. But then came your first real loss. Not a small setback you could laugh off, but a loss that hurt. A loss that made you question yourself. Suddenly, the market that had been your friend became your enemy. It had betrayed you. It had taken your money. Trading wasn't fun anymore. It was dangerous. Here's where the cycle begins. You decided the problem was your lack of knowledge. If you just knew more about the market, you could avoid losing. So you embarked on a quest for knowledge. You studied harder, analyzed deeper, learned new indicators, new patterns, new systems. But something strange happened. The more you learned, the more you expected from the market. The more you expected, the more the market disappointed you. Every time the market didn't behave according to your analysis, it felt like a personal betrayal. The disappointment drove you to learn even more, creating even higher expectations. You were trapped in what Douglas calls the cycle of doom. You weren't actually learning to trade better. You were learning to fear more sophisticatedly. Instead of simple fear of loss, you developed complex fears. Fear of being wrong, fear of missing out, fear of leaving money on the table, fear of giving back profits. Each new piece of knowledge, instead of making you a better trader, gave you another way to be wrong. Each expectation created another opportunity for disappointment. The very knowledge you sought for protection became the source of your paralysis. Experiencing a few or more winning trades can convince almost anyone that trading is easy. Recall your own experiences. Think back to those trades that brought a stream of money flowing into your account when all you had done was make a simple decision to buy or sell. Now, combine the extremely positive feeling you get from winning and getting money with no effort. And it's almost impossible not to conclude that making money as a trader is easy. But if that's the case, if trading is so easy, then why is it so difficult to master? Why are so many traders at their wits' end, grappling with the obvious contradiction? If it is true that trading is easy, and traders know it is because they've had the direct experience of how easy and effortless it is, then how can it also be possible that they can't make what they've learned about the markets work for them over and over again? In Lesson 3, the mental environment, Douglas discovered something profound. Your mental environment acts like a lens through which you perceive everything about the markets. Just like a computer's operating system determines how it processes information, your mental environment determines how you process market information. Your mental environment consists of memories, beliefs, attitudes, and expectations. Every trading experience creates a memory charged with emotional energy. These memories form beliefs about how markets behave. These beliefs create attitudes that color your perception. These attitudes generate expectations about future outcomes. Here's the deadly process. You take a trade that results in a painful loss. Your mind, trying to protect you, forms the belief breakouts are dangerous. This belief creates a cautious attitude toward breakout trades. This attitude generates the expectation that the next breakout will fail. When you see the next breakout setup, your expectation of failure causes you to hesitate. You enter late, place your stop too close, and exit prematurely. The trade fails, not because breakouts don't work, but because your fear-based execution sabotaged it. The failure reinforces your belief, strengthening the cycle. You're not trading the market. You're trading your beliefs about the market. Until you understand this, you'll remain trapped in self-defeating patterns. Our minds have a number of ways to shield us from information that we have learned to perceive as painful. For example, at a conscious level, we can rationalize, justify, or make a case for staying in a losing trade. Some of the more typical ways we do this are to call our trading buddies, talk to our broker, or look at indicators we never use, all for the express purpose of gathering non-painful information in order to deny the validity of the painful information. At a subconscious level, our minds will automatically alter, distort, or specifically exclude information from our conscious awareness. In other words, we don't know at a conscious level that our pain avoidance mechanisms are either excluding or altering the information being offered by the market. Consider the experience of being in a losing trade when the market is making consistently higher highs and higher lows, or lower highs and lower lows against your position, while you refuse to acknowledge you are in a losing trade because you have focused all your attention on the ticks that go in your favor. On the average, you are only getting 1 out of 4 or 5 ticks in your direction. But it doesn't matter because every time you get one, you are convinced the market has reversed and is coming back. Instead, the market keeps going against you. Lesson 4. The market owes you nothing. Here's a truth that might sting. The market doesn't owe you anything. Not a single penny, not a winning trade, not even fairness. When you lose, it's tempting to say the market took my money or the market stopped me out. But the market didn't do anything to you. The market simply facilitated the transfer of money from your account to another trader's account. This is the zero-sum game you've entered. Every dollar you make comes from another trader's loss. Every dollar you lose goes into another trader's pocket. The market is neutral, a mechanism for price discovery and wealth transfer. Nothing more, nothing less. Right now, thousands of traders are looking at the same charts you trade. Each sees a different opportunity based on their beliefs, fears, and expectations. The market doesn't care about your analysis, your needs, or your dreams. It simply reflects the collective actions of all participants. But here's the liberating part. If the market isn't doing anything to you, then you have complete power over your results. You don't need the market to change. You don't need special conditions. You just need to change how you think about and interact with the market. Taking responsibility means acknowledging and accepting at the deepest part of your identity that you, not the market, are completely responsible for your success or failure as a trader. The market's purpose is to facilitate transactions, but in the process, it also provides you with an endless stream of opportunities for you to take money from it. When prices move, that movement represents the collective actions of everyone participating at that moment. The typical trader wants the market to fulfill his expectations, his hopes, and dreams. Society may work this way, but the markets certainly don't. In society, we can expect other people to behave in reasonable and responsible ways. When they don't, and if we suffer as a result, society makes remedies available to rectify the imbalance and make us whole again. The market, on the other hand, has no responsibility to give us anything or do anything that would benefit us. This may not be the way markets are advertised, and certainly not the impression they want to project. But the reality is, every trader who participates in the markets does so for his own benefit. The only way one trader can benefit is if some other trader loses, whether the loss is in actual dollars, as in a futures trade, or lost opportunity, as in a stock trade. Lesson 5. The 5 Fundamental Truths. Mark Douglas identified 5 truths that, when fully accepted, revolutionize your trading. Don't just understand them intellectually, feel them, embody them. Let them transform your perception. Truth 1. Anything can happen. At any moment, for any reason, the market can do something that destroys your analysis. A news event, a large order, a technical glitch. Accept this completely, and you stop being surprised by market behavior. The markets are a collection of individuals, and individuals can do anything at any moment. This means that no matter what your analysis tells you, no matter how certain you feel, the market can prove you wrong in an instant. One trader with enough capital can single-handedly move the market against your position. A piece of unexpected news can reverse the strongest trend. A technical glitch can trigger a cascade of orders that obliterate your stop loss. Truth 2. You don't need to know what happens next to make money. Casinos don't know which specific bet will win, yet they profit consistently. They understand probability. You can too. Let go of the need to predict and embrace the power of edge execution. This truth directly contradicts what most traders believe is the key to success. Most traders believe that if they could just predict market direction accurately enough, they would be successful. They spend years trying to perfect their predictive abilities, adding more indicators, learning more patterns, developing more complex systems. But think about a casino. Does a casino know which specific bet will win or lose? No. Do they need to know? No. They make money consistently because they have a statistical edge that plays out over a large number of bets. Truth 3. There is a random distribution between wins and losses for any given set of variables that define an edge. Your system might have a 60% win rate, but the sequence is unknowable. 10 losses followed by 20 wins is possible, so is alternating wins and losses. Accept the randomness of distribution while trusting the reliability of probability. This is perhaps the most difficult truth for traders to truly accept at a functional level. Your trading system might have a 60% win rate over time, But that doesn't mean you'll win 6 out of every 10 trades in a predictable pattern. The distribution of wins and losses is random. You might have 10 losses in a row, followed by 15 wins in a row. You might alternate between wins and losses. You might have small wins and large losses for a period, then large wins and small losses. Truth 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. Not a guarantee, not a prediction. Just a statistical advantage that manifests over time. Your edge means nothing on any individual trade, but everything over a series of trades. Notice the key word here, probability, not certainty, not guarantee, not prediction, just a higher probability. If your system has a 60% win rate, that means that out of 100 trades, approximately 60 will be winners and 40 will be losers. It doesn't mean that any specific trade has a 60% chance of winning. This is a crucial distinction that most traders miss. Each individual trade is a unique event with an uncertain outcome. Truth 5. Every moment in the market is unique. That setup that looks exactly like last week's winner, it's not the same. Different participants, different context, different forces. Stop imposing past patterns on present moments. Trade what is, not what was. This truth challenges our mind's natural tendency to categorize and pattern match. Yes, markets display patterns. Yes, history often rhymes. But no two moments in the market are ever exactly the same. The participants are different. The context is different. The background conditions are different. That setup that looks exactly like the one that worked perfectly last week, it's not the same. It might behave completely differently. When you internalize these truths, fear becomes impossible. How can you fear loss when you've accepted that anything can happen? How can you need to be right when you know you don't need to know? How can you be surprised when you expect random distribution? Lesson 6. The dog story. How your mind creates your reality. Let me tell you a story that perfectly illustrates how your mind sabotages your trading. A young child encounters a dog for the first time. Naturally curious, he runs toward it with excitement. But this dog is aggressive. It attacks, biting the child severely before adults can intervene. The child is traumatized, the pain and fear etch deep into his memory. Months later, the child encounters another dog. This second dog is completely different. Friendly, gentle, tail wagging, wanting only to play. But what does the child perceive? He sees a monster. His body floods with the same terror he felt during the attack. He screams and runs to his mother for protection. Is the child seeing reality? No. He's seeing his past projected onto his present. His mind instantly associated the shape of a dog with the pain in his memory, triggering all the stored fear and trauma. He literally cannot see the friendly dog in front of him because his fear-based expectations filter out all contradicting information. This is exactly what happens to you every time you trade. Your last losing trade is like the first dog. It creates a painful memory. The next similar setup is like the friendly dog, completely different in reality, but perceived as identical through your fear. You can't see the valid opportunity because you're blinded by projected pain. Your mind automatically associates current market patterns with past painful experiences. That's why you freeze when you see familiar setups, why you enter late, exit early, or avoid valid trades entirely. You're not trading current market reality. You're trading your traumatic memories projected onto neutral price movements. The market, like the friendly dog, is simply displaying information. The threat exists entirely in your mind, created by associations you're not even aware of. Until you understand this projection mechanism, you'll remain its prisoner, seeing danger where only opportunity exists. Our minds are wired to associate and link anything that exists in the external environment that is similar in quality, characteristics, properties, or traits to anything that already exists in our mental environment as a memory or distinction. This natural tendency for our minds to associate is an unconscious mental function that occurs automatically. It's not something we have to think about or make a decision about. An unconscious mental function would be analogous to an involuntary physical function, such as a heartbeat. In the example of the child being afraid of dogs, the second dog, or any other dog he encounters thereafter, doesn't have to be the dog that attacked in order for him to experience emotional pain. There just has to be enough of a likeness or similarity for his mind to make a connection between the two. This connection, in turn, will cause the negatively charged energy in his memory to be released throughout his body, causing him to be overcome with a very uncomfortable sense of foreboding or terror. Lesson 7. Think like a casino, not a gambler. Imagine you own a casino in Las Vegas. Every night players win money at your tables. Sometimes they win big. Jackpots, hot streaks, perfect sessions. Do these wins concern you? Do you pace the floor worrying about them? Do you consider changing the rules or closing tables? Of course not. You understand something profound about probability. You know that over millions of bets, your mathematical edge guarantees profit. Individual outcomes are irrelevant. The law of large numbers is inevitable. If players wager $100 million at your blackjack tables this year, your 5% edge ensures approximately $5 million in profit. This profit includes all the big winners, all the hot streaks, all the lucky hits. It also includes all the losers, all the busted hands, all the unfortunate souls. When aggregated, the edge always manifests. Mathematical certainty emerges from random chaos. Now observe the gambler's mindset. He focuses obsessively on the next hand. Will this bet win? His emotional state swings wildly with each outcome. Win, and he's a genius. Lose, and the game is rigged. He looks for patterns in randomness, believes in hot streaks, thinks he can influence outcomes through ritual or force of will. Which mindset do you bring to trading? Do you obsess over the next trade like a gambler over the next hand? Or do you execute your edge with the calm certainty of a casino owner? Do you celebrate in despair with each outcome? Or do you remain emotionally neutral, knowing probability handles the results? Professional traders think like casino owners. They understand their edge manifests over hundreds of trades, not the next trade. They don't predict or hope. They execute their system mechanically, letting mathematics handle the outcome. They maintain the same emotional state, whether winning or losing, knowing both are part of the distribution. Casinos make consistent profits day after day and year after year, facilitating an event that has a purely random outcome. At the same time, most traders believe that the outcome of the market's behavior is not random, yet can't seem to produce consistent profits. Shouldn't a consistent non-random outcome produce consistent results, and a random outcome produce random, inconsistent results? What casino owners, experienced gamblers, and the best traders understand that the typical trader finds difficult to grasp is, events that have probable outcomes can produce consistent results, if you can get the odds in your favor and there is a large enough sample size. The best traders treat trading like a numbers game, similar to the way in which casinos and professional gamblers approach gambling. Lesson 8. The 3 sacred rules and the mechanical stage. Mark Douglas identified 3 rules that separate professional traders from gamblers. Violate any of these, and you're announcing to the world that you believe you can predict the future. Rule 1. Always predefine your risk before entering a trade. This means knowing exactly how much you're willing to lose before you click buy. Not hoping to lose, not planning to lose, but genuinely willing to lose. If losing that amount would cause emotional pain or financial hardship, you're risking too much. Predefined risk isn't just about stop losses. It's about complete mental and emotional acceptance of the potential loss. Most traders violate this rule because they don't want to accept the possibility of loss. They enter trades thinking, this one is going to work, or I'll decide where to exit if it goes against me. This is the gambler's mentality. This is believing you know what happens next. When you predefine your risk and genuinely accept it, something profound happens. The fear of loss disappears. How can you fear something you've already accepted? Rule 2. Cut your losses without hesitation when the market touches your stop. No questions, no second guessing. No, just a little more room. When your stop is hit, you exit. Period. Your stop loss represents the point where your edge no longer exists. Staying in beyond this point is pure gambling, hoping for a miracle rather than executing a system. Why is this rule so hard to follow? Because exiting at a loss triggers all our psychological pain. It means admitting we were wrong. It means accepting failure. It means taking real money out of our account. Our mind will generate dozens of reasons why we shouldn't exit, why this time is different, why the market is about to turn in our favor. But here's what you must understand. Your stop loss is not just a price level. It's the point at which your edge no longer exists. Rule 3. Have a systematic way to take profits. Hope is not a profit strategy. let's see what happens is not a plan. You must have objective rules for capturing gains. Without systematic profit-taking, emotions control your exits. Greed whispers hold for more, while fear screams, get out now. You need mechanical rules that remove emotional decision-making. These 3 rules form what Douglas calls the mechanical stage of trading development. You must become a trading machine. No interpretation, no discretion, no creativity. Just pure, robotic execution of your rules. Only after mastering mechanical trading can you add elements of intuition or discretion. You must go through this mechanical stage before you can trade intuitively, just like a pianist must master scales before improvising. Most traders try to skip this stage. That's why most traders fail. For your next 20 trades, commit to being mechanical, not creative, not intuitive, mechanical. This is how you build the neural pathways of a professional, not predefining your risk, not cutting your losses, or not systematically taking profits are 3 of the most common and usually the most costly trading errors you can make. Only the best traders have eliminated these errors from their trading. At some point in their careers, they learn to believe without a shred of doubt that anything can happen and to always account for what they don't know, for the unexpected. Lesson 9. Dissolving the 4 trading fears. Douglas identified 4 primary fears that destroy trading accounts. Understanding and dissolving these fears is essential for consistent profitability. The fear of being wrong. This fear runs deep because we equate being wrong about market direction with personal failure. We tell ourselves, I'm an idiot, or I should have seen that. But being wrong in trading is like a restaurant buying ingredients that spoil. It's not failure, it's a business expense. Professional traders are wrong constantly and don't take it personally. Listen to the self-talk that accompanies being wrong. I'm such an idiot. I should have seen that coming. How could I have been so stupid? Everyone else probably saw this except me. This self-talk reveals that being wrong means much more to you than simply being incorrect about market direction. The fear of being wrong causes multiple trading errors. It makes you hesitate on entries, waiting for more confirmation, which means you enter late with a worse risk-reward ratio. The fear of losing money. Money represents security and possibility. Losing it feels like losing your future. This fear causes tight stops that get hit by noise, premature profit-taking, and paralysis when facing valid setups. The solution? Only trade with money you've mentally written off. If you can't afford to lose it, you can't afford to trade it. The self-talk that accompanies losing money is painful. I can't afford this loss. This was my rent money. I'm giving back all my profits. My spouse is going to kill me. I'll never recover from this. The fear of losing money causes traders to use stop losses that are too tight, getting stopped out of good trades by normal market noise. The fear of missing out. Watching the market move without you feels like money being stolen from your account. This fear drives chase entries at terrible prices, overtrading marginal setups, and revenge trading to make back missed profits. Remember, the market offers infinite opportunities. Missing one means nothing when thousands await. The self-talk is torturous. I knew I should have taken that trade. Look at all the money I'm not making. Everyone else is probably in this trade except me. This was the easy one, and I missed it. I'll never get another chance like this. The fear of missing out causes traders to chase markets, entering at the worst possible prices just to be involved. The fear of leaving money on the table. You exit with profit, then watch the market continue in your direction. The money you could have made haunts you. This fear causes traders to hold too long, re-enter exited positions, and abandon profit rules. Truth: you can never capture entire moves. Trying guarantees giving back profits. The self-talk is frustrating. I always get out too early. I left so much money on the table. If only I had held longer. I'm terrible at letting profits run. The big money was made after I got out. The fear of leaving money on the table causes traders to hold winning trades too long, watching profits evaporate as the market reverses. The master key that dissolves all 4 fears. Complete acceptance of risk. When you truly accept that you might be wrong, lose money, miss out, or leave profits, the fears evaporate. They can't exist in a mind that has already accepted what it fears. This acceptance isn't resignation. It's freedom from emotional tyranny. Here's the truth that dissolves all 4 fears. When you completely accept the risk, none of these fears can exist. You can't fear being wrong when you've accepted that you don't need to be right. You can't fear losing when you've already accepted the loss. You can't fear missing out when you know another opportunity is always coming. You can't fear leaving money when you followed your plan perfectly. Lesson 10. Inside a professional trader's mind. Let me show you how a consistent winner actually trades. Sarah begins her day at 6:30 a.m., but she doesn't check overnight news or pre-market prices. Instead, she reviews her trading rules, the same rules she's followed for years. This isn't about learning, it's about reinforcing discipline. Her rules are simple and specific. Risk no more than 1% of account equity per trade. Take only A-quality setups as defined by her system. Exit immediately when stop is hit. Take partial profits at first target. Trail stop on remainder. Maximum of 3 trades per day. No trading during major news releases. Stop trading after 2 consecutive losses. ETA market opens. Sarah scans for setups mechanically. No excitement when one appears, just recognition that her edge is present. She calculates position size, 1% risk, 500 shares, 50-cent stop, orders placed before entry. No decisions needed while in the trade. 10:45 a.m., stop hit, loss of 250. Notice her response, nothing. No anger, no frustration, no self-blame. She logs the trade and marks it successful because she followed her rules perfectly. Success is defined by execution quality, not outcome. Taupas PM, another setup triggers. This time, it works. Partial profits at target, stop to break even. No excitement, no genius complex, just mechanical execution. The market continues higher, trailing stop locks and gains. She's aware, but emotionally neutral. 3:47 p.m., trailing stop, hit, total profit 1,650. She logs the details, marks another successful execution. Day ends up 1,700 after commissions. Good day? Yes, because execution was perfect. If she had lost $5,800 with perfect execution, it would still be a good day. This is professional trading. No drama, no emotional swings, no hoping or fearing. Just systematic execution of an edge with complete emotional neutrality. Individual trades mean nothing. Perfect execution over time means everything. Notice what's absent from Sarah's day. There's no drama, no emotional highs or lows, no desperate searching for trades, no agonizing over decisions, no celebrating victories or mourning defeats, no checking account balance every 5 minutes, no seeking validation from others, no revenge trading, no overtrading, no hope, no fear. This emotional flatness isn't because Sarah is a robot or doesn't care about money. It's because she's aligned her beliefs with market reality. She knows that any individual trade means nothing. She knows that her edge manifests over time, not in each trade. She knows that perfect execution is all she can control. Lesson 11. Entering the zone. The zone isn't mystical. It's the natural state of a mind freed from conflicting beliefs about markets. When mental noise stops, no hope, no fear, no prediction, pure awareness remains. You perceive price movement without distortion. Setups announce themselves. Entries and exits become obvious. You're not thinking, you're flowing. Athletes know this state intimately. Time slows. Performance becomes effortless. Everything clicks. In trading, it manifests as profound knowing without knowing how you know. You see your edge forming and act without hesitation. Market movements seem logical, even though you understand prediction is impossible. But here's what most traders don't understand about the zone. It's not a mystical state reserved for the chosen few. It's not something you achieve through force of will or positive thinking. The zone is simply the natural state of a mind that has released all conflicting beliefs about market behavior. Your normal state of consciousness is filled with mental noise, hopes about what might happen, fears about what could go wrong, memories of past trades, worries about the future, analysis and counter-analysis, internal arguments about what to do. This mental noise acts like static on a radio, interfering with your ability to perceive market information clearly. You can't force the zone any more than you can force sleep. You can only create conducive conditions: physical preparation, rest, nutrition, exercise, environmental calm, minimal distractions, emotional equilibrium, no external life stress, process focus, execution over outcome. The zone emerges naturally when you stop trying to enter it, when the 5 fundamental truths become your operating system. when the four fears dissolve through risk acceptance, when mechanical execution becomes second nature, when you stop fighting market uncertainty and start flowing with it. The zone becomes accessible when you've internalized the 5 fundamental truths so deeply that they're no longer beliefs you hold, but simply the way you see reality. When anything can happen, you stop trying to predict. When you don't need to know what happens next, you stop analyzing obsessively. When you understand random distribution, you stop attaching significance to individual outcomes. Remember, the zone isn't always optimal. Sometimes mechanical execution serves better, especially when learning or returning from a break. The zone is the master's state, earned through disciplined practice, not a shortcut for novices. Lesson 12. Your 30-day transformation protocol. Knowledge without action is entertainment. Here's your practical 30-day transformation protocol. Week 1, awareness phase. Stop all live trading. Paper trade while documenting every thought, emotion, and physical sensation. Write continuously. This looks good. What if I'm wrong? I can't afford another loss. Document the mental noise. Each evening, explore deeper beliefs through sentence completion. Money is. Success means. I deserve. The market is. Don't judge what emerges. You're mapping your current mental environment. By the end of week 1, you'll have a comprehensive picture of your psychological trading patterns. You'll see clearly how fear and greed manifest in your thinking. You'll understand which beliefs sabotage your execution. You'll know exactly what needs to change. Week 2, reprogramming phase. Morning. 20 minutes of visualization. See yourself executing mechanically, following rules despite emotions. Feel the calm confidence of systematic execution. Paper trade with full emotional engagement. When fear or greed arise, acknowledge them, then act from rules anyway. You're learning to operate independently of emotions, not eliminate them. Evening. Celebrate every instance of disciplined behavior. Did you follow your setup rules despite fear? Victory. Exit at your stop without hesitation. Victory. Skip a marginal trade. Victory. For each limiting belief you identified, create and repeat a specific counter-belief. But don't just recite words. Feel the truth of the new belief. Imagine trading from this new perspective. See yourself executing flawlessly while holding this belief. Week 3. Integration phase. Resume live trading with quarter-size positions. This isn't about profit. It's about practicing new patterns with real consequences. Document execution quality, not financial results. Maintain dual awareness, part attention on markets, part observing your internal state. When old patterns arise, pause, breathe, reconnect with new beliefs, then act from discipline. After each trade, immediately document 2 things: whether you followed your rules perfectly and what your internal experience was like. Don't focus on whether the trade made or lost money. Focus entirely on execution quality and psychological state. Week 4. Expansion phase. Gradually increase position size while monitoring for old patterns. If fear or greed return strongly, immediately reduce size. Build consistency before seeking profits. Continue all practices until mechanical execution becomes natural. Judge progress by execution quality, not account balance. Perfect execution with losses beats profitable rule violations. Add weekly review and planning. Every Sunday, review your week's trading from a psychological perspective. What patterns do you notice? Where are you strong? Where do you still struggle? Plan specific focuses for the coming week based on what you discover. Closing. The matrix moment. You've been living in 2 realities. In one, you need to predict, control, and be right. In the other, you flow with probability, accept uncertainty, and profit from chaos. Like Neo in the Matrix, you now see the code. The market's movements are just numbers flowing. Your job isn't predicting the code, but positioning yourself where probability favors you. You have 3 choices: blue pill, return to prediction, analysis paralysis, and the 95%. Red pill, accept uncertainty, think in probabilities, join the 5%. Black pill, know but do nothing, the worst choice. The market continues its eternal dance, offering identical opportunities to everyone. But whether you can perceive and act on them depends entirely on your mental framework. Will you keep fighting uncertainty, or learn to dance with it. Every master trader stood where you stand, facing the same choice. They weren't special, they just decided to think differently. Their transformation began with one simple acceptance. I don't need to know what happens next. Your first assignment? Tonight, write one limiting belief about trading. Maybe I must be right, or the market owes me. Then write its replacement. I follow my edge, or I earn from probability. Post this where you'll see it every morning. Read it, feel it, become it. The market hasn't changed. It never will. It will continue doing anything at any moment. The only variable that can change is you. Remember Mark Douglas's final message. The answer is not in the market. The answer is in your mind. Change your mind, change your results. The zone awaits, not as a destination but as a way of being. Not for the chosen few, but for anyone willing to align their mind with market reality. You now stand at a crossroads. Behind you lies the path of the 95%, the path of prediction, control, fear, and failure. Ahead lies the path of the 5%, the path of probability, acceptance, and consistency. The choice has always been yours, and it always will be. Welcome to Trading in the Zone. Welcome to the 5%. Your journey begins now. The market hasn't changed. You have.